Hi everyone, welcome to Phillip Securities Research Monday morning call. We have stock counter updates and results from Nvidia, Frencken, City Development, Singapore Airlines, Lendlease REIT, ST Engineering, Singtel, and Telechoice International. We also have a site visit note from Elite UK REIT. Following that, we have our S&P 500 technical analysis, the Singapore REITs monthly, as well as our Singapore weekly. So before we start, just a disclaimer, the information provided here is not financial advice. Please consult your advisors. So with that, I'll pass on to Iqbal for Nvidia.
Yeah, thanks, Hashim. I'll be presenting on Nvidia's first quarter 27 results. Next slide, please. Yeah, so Nvidia's revenue and PATMI is within our expectations. For Nvidia, what drove this quarter's revenue and PATMI growth was the data center segment. As you can see, data center revenue spiked up 92% year on year, and this is being driven by hyperscalers' revenue ramp for Nvidia's Grace Blackwell GB300 GPU racks. Yeah, so that is the positive for Nvidia. And second positive for Nvidia is that they gave a very aggressive guidance for second quarter revenue to accelerate to 95% year on year. This is in comparison to this quarter's 85% year on year, as can be seen in the top row of the table. We do think that this will be mainly driven by hyperscalers' CapEx expansion and also from the other segment, which is Nvidia's AI cloud industrial and enterprise. So in this quarter itself, Nvidia had a new reporting standard whereby it broke down data center revenue into two segments, hyperscale and the other segments which represent AI cloud industrial and enterprise. So what this segment includes will be the AI native clouds, for example, like CoreWeave, Nebius, as well as revenue from sovereign nations and also the few 100,000 enterprise companies worldwide. Yeah, so I do believe that this segment will drive growth, the next phase of growth for Nvidia, because Nvidia CEO also guided that he believes Nvidia's revenue will grow faster than what hyperscalers guided for CapEx. Yeah. As for this quarter, Nvidia also announced higher dividends as well as share repurchase. For the negative for Nvidia, it reported, it consolidated the revenue from gaming, automotive, OEM, as well as professional visualization into one chunk called edge computing. So edge computing segment decelerated to 29% year on year from the previous quarter, 55% year on year because of lower demand in the gaming segment because of higher memory prices. Yeah, so for the guidance itself, as mentioned, Nvidia guided that its revenue should grow faster than hyperscalers' CapEx growth. And we do think that over the next 1 to 2 years, the ACIE segment, which is the AI cloud industrial and enterprise, will be driving this growth. As can be seen in the chart at the bottom left-hand corner, there is the chart of the CapEx expectations for CoreWeave and Nebius, which is the red color bar, as well as Tesla. So for CoreWeave and Nebius, because they provide AI cloud solutions and compute solutions to sovereign nations as well as enterprises that want to reduce reliance on the hyperscalers itself. So we do think that this spike in CapEx expected from these companies will be able to benefit Nvidia in the ACIE segment. For Tesla's CapEx is expected to drive growth in the edge computing segment because Tesla will be spending on robotics, EV, as well as physical AI. Yeah, so we do think that will benefit Nvidia's edge computing segment. For Nvidia, we maintain buy. We raised our target price to 285 because we raised our FY27 revenue and PATMI forecast because Nvidia also onboarded a new customer, Anthropic, and it also reported that it has new visibility to at least $20 billion in standalone CPU revenue for FY27 itself. And we do think that this CPU revenue will the entire pie will continue to grow even larger because Nvidia sees a $200 billion TAM within CPU itself. Yeah. So that's for Nvidia. Next slide, please. Yeah, I'll be presenting on Frencken as well, first quarter update. Yeah, next slide. They released their first quarter update with limited financials, but yeah, so this is in terms of revenue itself is within our expectations. PATMI slightly below expectations because of the softer semiconductor segment. So for Frencken itself, it has five main segments as can be seen in the table on the left. Medical and automotive was what supported semiconductor softer results. So for medical itself, it increased 5% year on year because of higher demand for the digital pathology equipment from Europe. For automotive itself, there's an increase of 12% year on year in revenue because of higher volumes of the radar antennas. Yeah, so for the negative of Frencken, semicon revenue dropped 7% year on year because there's a decline in EUV orders from Frencken's largest customer. Yeah, and this decline in EUV orders, we do think that it is transitory because ASML is preparing for the ramp in high-NA EUV at the second half of this year. And as you can see in the chart at the bottom left-hand corner, this is the breakdown of the revenue from logic and memory for ASML itself. So as you can see for the memory revenue, we do expect memory revenue to spike this year. And we do think that this increase in demand for ASML's high-NA EUV will come mainly from the memory players. Yeah, so that's our outlook for ASML. For Frencken. We do think that because of this increase in demand from memory players for ASML's high-NA EUV machines at the second half of this year, Frencken will be able to benefit from when the high-NA EUV begins production. Yeah. We do think that the automotive segment is expected to be volatile because of order delays from the Middle East conflict, but gradually in next year itself, it should start to ramp, also indicated by Frencken's automotive customer. For Frencken, because of the recent share price rally, we downgraded to accumulate, but we also raised our target price to 330. Yeah, so we also adjusted our revenue and PATMI assumptions. We lowered it by 4% because of the soft demand expected in first half because of the consolidation. And in terms of valuations wise, Frencken's trade at 30 times 1 year forward PE, which is still at a discount to its peers average of 37 times. For the peers, for Frencken's peers, we take the Singapore tech companies, for example, UMS, AEM, yeah. So these are its peers that we take. Yeah, so that's for Frencken. I'll hand over the time to my other colleagues. Thanks.
Yeah, thanks, Iqbal. Yeah, I'll run through CDL's operational update. So it's a first quarter 2026 so-called business update, and there were no financials. So excuse me, there were no financials provided. So it was a strong quarter for them. Yeah, next slide, please. Their property development segment remains strong, resilient. It's down year on year. First quarter sold 600 plus million worth, while first quarter 2025 sold about 2 billion. That's mainly because first quarter 2025 they had the launch of the ORI, so that was 88% taken up at launch. So that drove the performance of first quarter 2025 results. So there was a very high base, but first quarter 2026 performance was driven by Newport Residences. So Newport Residences is a ultra luxury freehold property. So this having sold 57% at launch weekend, we think that is really a upside surprise to us. And right now, Newport Residences is already 78%. So that's very, very strong demand for ultra luxury CCR property. Yeah, so their CDR's other projects continue to sell well. So the Ori, the Mist, the Grand, Normal Grand, all of these have already sold over 88% of their units. And upcoming, they plan to launch Lucent Grand at Lakeside Drive. So this is slated for launch in the third quarter of 2026. And they also plan to launch Woodlands Drive EC17 and Woodlands Drive 17 at the EC and another EC at Senja Close. So that's for launch at first quarter 2027. So for the upcoming launch at Lucent Grand, we think the demand will be strong. That's mainly because it's just located beside the Lakeside MRT station. and they will also benefit from the upcoming Jurong Lake District. Yeah, and one thing to note about the upcoming ECs in 2027, the Woodlands Drive and the Sandra Close, is that they will not be impacted by the new EC policy changes that were announced on 8 May. So if you do not know what these changes are, so there are a few. So it's mainly the extension of the minimum occupancy period from 5 years to 10 years, with a full privatization after 10 years from 15 years, and also the removal of the deferred payment scheme and the increase of the first-timer quota from 70% to 90%, and as well as the extension for this first-timer priority period for new EC from 1 month to 2 years. Yeah, so next is their hotel operations. It remained really resilient. So that's despite the Middle East conflict. We saw travel demand slow since the start of the conflict. So that happened in March. But we still see RevPAR growth of 4.3% for CDL's portfolio. So it's really supported a broad base by all these countries that I stated above. So Singapore, Australia, Asia, Europe, and New York. Yeah, so for the outlook for CDL, we are expecting more divestments in the pipeline. So that's mainly to unlock value and reduce the net gearing towards the 60% target in the medium term. So currently their gearing is at 72%. So that's the net gearing. Some potential assets that they could possibly divest or in the pipeline are the China commercial assets, as well as the UK development sites that they have mentioned previously in the FY25 results. So that's about 800 over $1 million. Yeah, so these are the potential divestment targets. Yeah, so more for the operating performance outlook, we still do expect low single-digit RevPAR growth for the portfolio, despite the ongoing uncertainties. For Singapore, the investment properties remain really resilient with high occupancy rates across both office and retail. Yeah, and they are also still undergoing the strategic review, so we are expecting an outcome by next, or rather more on this strategic review, the so-called the update by June, which is next month, end of next month. So some potential outcomes for this could be more fund management initiatives. So that could include potentially recycling non-core assets into private funds. So that includes their PRS sector. So potentially putting that into a fund structure as well. So that is really to so-called unlock value and enhance the capital efficiency. Yeah, so no change to target price and our recommendation. Yeah, so buy call. Yeah. Next slide, please. Yeah, so now I move into the REITs monthly update. So in this update, we try to give a overview of what happened in the first quarter 2026 results, because that is just ended this past week. So from what we noted is that global tensions are currently still contained with a limited impact so far. But upcoming, there might be some headwinds. Yeah, I'll speak more about that later. Next slide, please. Yeah, so for the share price performance in April, it rebounded, but that's mainly from the de-escalation of the Middle East conflict. So that resulted in a rotation back into yield instruments. So we see the best performer was retail for the month. Yeah, overall index is up 3.2%, but year to date is still down 5.1%. Yeah, next slide, please. Yeah, so now we will give an update of the first quarter 26 result, as well as the outlook for each subsector. Yeah, if you want more details, you can it's in the report. Yeah, so just some highlights from that is we still do expect a 3% DPU growth on average for S-REITs. So that's mainly by the contractor rental escalations imbued in most of the leases that S-REITs have, as well as positive rent reversions and continued easing of financing costs. Yeah, so we've seen the SORA decline to below 1.1%. So that's like over 130 basis points lower year on year. So we still do expect most S-REITs to benefit from this lower year on year interest costs. Yeah, and even if their so-called fixed rate hedges have already been repriced, we still think interest costs will remain at least stable, assuming rates remain flat, like central bank rates or base rates remain flat. So year on year, we still think likely to have some interest rate savings across most REITs. Yeah, so for retail, rental reversions in the first quarter of 2026, results across most REITs were in the mid to low teens. So we also think going forward for the rest of 2026, we are looking at similar mid to high single digit range. So this is really underpinned by healthy occupancy costs and sustained demand from F&B and experiential lifestyle, as well as some essential services. Yeah, so a lot of these REITs, they are also undergoing AEI or refurbishments to their properties. So that would likely further support rental upside in the longer term for these REITs. So we also noted other operating metrics for retail, like there were resilient tenant sales. So tenant sales were up roughly low single digit to mid single digit for year on year. And we also see steady footfall and really limited supply in key catchment areas that will continue to help support rental growth for retail. Yeah, so moving on to industrial. For the first quarter 2026, the data center REITs really performed really well. So we've seen a very strong rental reversions continue for some of the DC REITs, like Keppel DC REIT saw 50% or over 50% rental reversion year on year. Digital Core also saw very strong reversion, 40%. So we think that's a structural demand and a circular demand. So data centers REITs will continue to perform strongly. So that's really underpinned by the strong demand for strong hyperscale demand and tight supply as well. Yeah, so excuse me. Yeah, so for logistics and warehouse, the demand, it was still resilient for the first quarter. So this is mainly supported by the supply chain front loading and inventory buildup from uncertainties from the war. So there's some front loading in supply chain. So this really helped to support the demand for logistics and warehouse also. So but for in the second, I saw a comment, very bad echo. No, I'll just continue. So for second order effect from higher oil prices, so that could incrementally lift transportation and operating costs for these tenants' margins as well. So if this persists, it could temper the demand for industrial space in the longer term. So we are continuing to monitoring the second order effect from this so-called the impact of higher oil prices, the impact that would have on these tenants and how stable and whether there will be any headwinds or any margin compression on that front. And tenant profitability basically. Yeah, so next sector we move on to is office. So in office, the first quarter reversions were still very strong. So it was mid single digit to high single digit. Yeah, thanks for the reply. Yep. Yeah, so mid single digit to mid single digit to low double digit for office. So this is really backed by tight supply in the core CBD and low supply, limited supply for prime grade A office space as well. So one note is that a lot of tenants, since the start of the war, they were taking a longer time to commit to relocation decisions. And there are also a lot of these existing occupiers, they are likely to renew their leases rather than expand or relocate due to all these uncertainties. So basically it's still strong demand and occupancy levels are still very stable. And with that, we still expect the occupancy rental reversions to remain in the high single digit range for FY 2026. So this is really backed by limited core CBD supply and resilient demand, basically from tenants renewing their leases instead of trying to relocate and such. Yeah, so we think the sector that will be impacted the most will be hospitality. So for hospitality, the higher oil prices will really trickle down into higher airfares and travel costs. So that will weigh on the discretionary spending and long haul demand for travel. So that will likely soften RevPAR growth also if uncertainties continue. So it's from at this point in time, it's still really hard to say the longer term impact on the war would have on travel. But so far we've seen first quarter RevPAR, despite the war starting end Feb, right? The first quarter RevPAR performance was still relatively resilient. So most hospitality REITs reported low to mid single digits despite all these tensions. So in first quarter, it was reported that leisure demand was still resilient, but there were modest cancellations linked to the Middle East conflict. and there's also a moderation in new bookings and forward bookings. And corporate travel also seems to be more cautious, and the confirmations were really made last minute instead of usually a few months in advance. So there is really a slowdown. Um, yeah, but generally for hospitality, we still see that the near-term performance was held up better than we originally expected. But we are cautious going forward on the sustainability given this sensitivity to travel and discretionary demand. Yeah, so that's just a outlook for the what we saw from the first quarter 2026 results. And next slide, please. So we move on to more of the monthly indicators that we continue to follow. So we see the yield spread continues to be attractive, trading at a historical yield at about 3.8%. So this is yield spread basically is what you get, the yield you get by investing in S-REITs over a risk-free rate proxy, which is the 10-year yield. So at 3.8, we think this is attractive, and it is a good time to enter because we are expecting DPU growth after all. So if that, the yield spread will continue to increase with DPU growth. Yeah, and looking at the interest rates, the SORA really continues to decline, like I mentioned. So at the start of May was 1.02, so now it's around slightly below 1.1. So the REITs will still benefit from lower base rates, especially if they have more loans in SGD denominated loans. Yeah, next slide, please. Yeah, so looking at forward dividend yield, it declines slightly, but that's mainly because of the share price performance. For the S-REITs index, the price to NAV, usually when we see over the past few instances like COVID and 2016, we see when the price to NAV reaches one-time standard deviation below the mean, roughly around that time we see a rebound in the S-REIT prices. So at this point in time, previous month it hit minus one-time standard deviation. So we see at this point there was a rebound after it hit around that region. So we still think there is a potential based on valuations for REITs. Next slide, please. Yeah, so moving on to more macro. So retail sales still strong. So this is also similar to what we saw in the first quarter results. So tenant sales were also in line, so around 3 to 5% tenant sales growth. So it's really in line with what we see at the REITs. Next slide, please. And for hospitality, international visitor arrivals, it fell 5% in April. That was really part of it was because of Indonesia. The visitor arrivals from Indonesia recorded a significant decline of 31%. Yeah, but what we see from RevPAR is that it's still up almost 6% year on year in March. So we still think for the rest of this year, we still expect a low single-digit RevPAR growth for Singapore hospitality sector. Yeah, so it's mainly driven by improvement in hotel occupancy as well as I think the average daily room rates are largely flattish. Yeah, that's our view. Yeah, next slide, please. Yeah, so this is our REIT coverage. Yep, that's all for me. I hand over time now to Hashim. Thanks.
Thanks, Darren. Yep, I will go through Singapore Airlines full year financial results. So for second half 26, their revenue was up 8%, and the operating profit was up about 72%. So there was a huge jump in their operating profit. They were not as affected by the Middle East conflict compared to their other Asian carriers, and that's mainly because they have hedges on both your jet fuel as well as your crude oil. Most carriers or airplanes in the region only have a hedge on crude oil, so they are exposed to the refinery margin on your jet fuel. So because of that, you can see that their operating profit jumped quite a bit. For their passenger load factor, it's quite stable at about 88%. And because of their hedges, they also booked a bit of hedging gains of about 143 million. Negatives wise, the associate earnings continue to be a drag. So associate earnings, the majority comes from Air India. Total associate losses were about 512 million for second half and a total of 800 over million for full year 2026. And Air India hasn't been doing well, and that's mainly because of some regulatory issues as well as the way it's run. So regulatory wise, you have your Pakistan airspace closure. So because of this, planes that go from India to Europe have to take a longer route, and a longer route means more operational costs for this Air India. And Air India also does not have a hedging program in place. So the fuel cost increase, it's being absorbed by Air India in its books. And going forward, we do expect the losses to persist in the near term. So outlook wise, currently or as of March, SIA's carrying value of Air India is about 1.1 billion. It has been written down since its investment, and if there's going to be continued losses, it's going to eat up into its carrying value. So once it gets to zero, SIA will not record losses from Air India into its books anymore. And if that happens, we can see that overall SIA's operating profit has been quite stable and quite good. That's going to flow into its earnings, which can improve its bottom line. Apart from that, SIA's response to this whole conflict is that they have increased their plane ticket prices. But this is essentially a pass-through because you're not profiting from it. You're just mitigating the cost increase. And their cheaper hedges have already expired, and now they have a new set of hedges, mainly on jet fuel, as well as on crude oil. But going forward, we expect margin compression because of higher costs. Currently, their fuel cost makes up about 25% of their FY26 revenue. So we maintain a neutral rating with a target price of $6.41, and it's trading at a price to book value of 1.1 times. So next, I'll go through a Lendlease REIT third quarter update. So for Lendlease REIT, there were no financials provided, but overall their performance was quite sound. Their occupancy increased about 3.2 percentage points. Their cost of debt fell, and yep, one of the main positives we observed was that their retail rental reversion was quite strong. So it was about 12.2%, and that was mainly due to a few tenants. So mainly in F&B, gold and jewelry, as well as athleisure. And going forward, we expect a high single to low double-digit rental reversion. So they acquired a PLQ Mall 100% quite recently, and they are currently doing a asset enhancement initiative. So at levels 1 and 2, totaling about 16,000 square feet, is undergoing this AEI. Level 1 is fully pre-let. Level 2, leasing is currently in progress, and we expect income contribution from the second half of 2027. So the company also refinanced their PLQ loans because they took on the loans into their balance sheet, and that gave them about $2 million in annual savings. And what they guided was that there will be about 2% DPU accretion after acquiring PLQ Mall. The 2 million interest savings also improved their interest coverage ratio. We observed that it jumped from 1.5 to 1.8 times, and they did a gem office divestment, which led to them having 8.9 million in disposal proceeds, which they haven't used yet, but they have marked it for future AEI. So negative wise, they have an asset in Italy, office asset called Milan Building. They have 3 buildings. The third building is still being occupied, or occupancy initiative is still undergoing. Currently, it's about 51% occupied. Compared to first quarter, there hasn't been much of progress in terms of the occupancy initiative. And their plan for Milan Building 3 is to increase their occupancy and then to sell it. But looking at transactions in the market, Most of so the asset is located in a sub-market. It's not in central Italy, and the sub-market transactions has fallen quite a bit, over 41%. But management has indicated that they have commenced divestment evaluation, so it's very early stage. So outlook for Lendlease REIT, we do expect retail rents to increase about 2% in 2026, and that's mainly from a MICE strong concert calendar, as well as due to strong tourist arrivals, mainly from US and Indonesia. And for the Sky Complex Building 3, we do think it will be a bit challenging to divest. They have to increase the occupancy of the building before they sell it, and current first quarter transaction in that specific region, most transactions were small, less than 1,000 square meter. So we are not observing any large transaction in the market. So uh, we think Lendlease will likely take a wait and see approach before they divest the asset. So we have a buy rating on them with a target price of 73 cents, and it's trading at a price to NAV of 0.7 times. So next, I'll go through Elite UK REIT site visit note. So Elite UK REIT, they have over 148 assets, mainly leased to the Department of Work and Pension. So that's a government tenant. So it's a stable government lease. So we visited about 4 job centers from DWP. So job centers is where so the main function of job centers, firstly, is to help graduates find jobs, and secondly, to take care of welfare benefits. So in the UK, the main welfare benefit is your universal credit. So to get your universal credit, you have to go down to the building, conduct an interview, have a few assessments, and that's where the building comes into play. So we visited 4 job centers: Broadway House, Peckham Job Center, Oates House, as well as Nutwood House, Canterbury. So one of the smaller buildings was a Broadway House. It's about 17,000 square feet, but it has a strong universal credit claimant, about 40,000 plus. The catchment is one of the more rougher neighborhoods, so it has a poverty rate of 31%, and DWP building is quite instrumental in driving your employment in that area. So apart from that, you have your Peckham Job Center. So Peckham Job Center, what we observed, main thing was that it has a optionality to repurpose, because it's a huge plot of land, and there is adjacent land right beside Peckham Job Center that, if acquired, could make for a larger plot of land that could be used for either PBSA or build to rent. We also visited Oates House. Oates House recently went through asset enhancement initiative. So if you look at the picture, you can see that it's furbished, and it's also one of the rougher neighborhoods. So in Stratford, you can see the difference between your high-end retail malls compared to your rougher neighborhoods. And lastly, for Priory Court Dover, it's not a job center. It's a lease to your revenue and customs department, and it has sensitive government agencies. So we can't share the tenants, but we feel that the tenant base will likely stay in Priory Court for a long term, because it's not easy to find such a large piece of land. It's over 70,000 square feet, and they need the space because they are not just housing one tenant. They are housing different tenants that are like sensitive in nature. So of the assets we visited, what the management guided was that there may be some repositioning opportunity in the future. So for DWP, they recently re-geared their leases, and there were over 70% of the leases that was due in FY28. But now it has been more staggered, and their WALE has increased to over 7 years from over 2 years. So one of their repositioning optionality is your purpose-built student accommodation. So we visited Cambria House, which is a 348 bed PBSA. Pre-planning consultation has already been completed, and they're going to submit a formal planning application. So for the UK itself, the higher education enrollment numbers have been increasing. Postgraduate declined a bit, but that's because of your visa numbers. But overall, total higher education student numbers are on the rise. And third-party accommodation, so for full-time students staying in the UK, about 30% stay in third-party accommodation, and it has been increasing at a CAGR of over 17%. So it's making up a larger portion of your dwelling for your full-time students in the UK. And Erasmus Plus, it's a student exchange program, is coming back in 2027. And we think this will also drive your PBSA demand. So the second repositioning option is your build to rent. So build to rent is just your private residential. We visited one from Lendlease called City Light Point. It's not owned by Elite, but I think the motive was for them to show if they get into this build to rent space, what's the type of building we are going to be looking at. So for build to rent in specific, there's one regulation that just came into effect this month. It's called the Renters' Right Act. So what this does is abolish your fixed period tenancy. So previously you can have your 1 year tenancy. Now it's going to be on a rolling period, say for 3 months, and then it's going to be renewed every 3 months. And we think this is going to be operationally challenging for your smaller landlords. And so they will likely exit the market, and the demand is going to come to your institutional landlords like Elite if it chooses to get into your build to rent. So overall, in conclusion, we think Elite UK REIT has a strong government tenant base, low risk, and for assets that may not be renewed, it has strong repurposing optionality into either PBSA or build to rent. So we have a buy on them at 41 cents, and it's trading at a price to NAV of 0.87 times. So with that, I'll pass on to Zain.
Thanks, Hashim. Good morning, everyone. I'll move on to the technicals. Next slide, please. So on the S&P 500 last week, in terms of the price action, at the start of the week, there was a pullback from the key trendline resistance, and then afterwards, price still managed to hold support at the 7,338 swing low level. And afterwards, we saw a recovery towards the end of the week. So I think we are likely to see the trend of higher highs or continue ahead this week to retest first the 7,517 swing high level. And afterwards, we could see price try to retest the upper Bollinger Band again, closer to 7,600. So that will be likely the resistance area for this week. In terms of support, it's likely to be at 7,410 to about 7,460, which was the level price broke out in Wednesday onwards last week, as well as where the 5 and 10 SMEs are currently at right now. So that's all from me. I'll hand over time to Paul for ST engineering things.
Yeah, thanks. Thanks, Zain. So let me just move on to ST Engineering first quarter. Sorry, it's not results, it's actually update. So when it comes to update, they only give very limited financials like all company. So as the title suggests, long runway for growth. So we think there's a lot of growth opportunities for ST Engineering. If you had gone back to the other slide, but let me just move on since we're on this slide. So the first quarter, they only give revenue numbers and order book. So there isn't much details, but generally it's within expectations. So it's trending within our forecast. So the revenue is actually growing at 15%. The headline number you see is 11, looks a bit slow, but because last year they sold one US company, so you strip that out to normalize, you're talking about 15% growth. They don't actually give actual earnings number, but they did hint that the earnings growth was more than 15 and is on track. It's all very coded type of answer, but I mean it's exceeding 15% the earnings growth, and it's also within their 2025-29 target to grow earnings 5 percentage points faster. So it's like a mysterious thing, but anyway, we should assume that the earnings for first quarter is probably around 20%. The positives is that so what provided the growth was commercial aerospace. So for those who may not know, I think most of us won't really can recall, but commercial aerospace is actually MRO, which they do engine maintenance. So the big one that they do is the LEAP engine, which is the most used engine that is used in the A320neo, the single aisle low cost carrier planes, short haul single aisle. So they are doing a lot of maintenance for that, and they are in the upper tier in terms of a vendor kind of maintenance. So that gives them better access to spare parts and so forth. Yeah, but if you read the report, there's a bit more details there. The other thing is that they're also doing engine parts, the nacelle part of an engine, like the outer rim of the engine. So that is also doing well. The other positive on the results is satellite. So satellite is always the one giving them problem, which they are looking to sell, is under the thing called USS here. So satellite with SpaceX coming up, that's almost impossible. You can go and compete with them, with Starlink coming out, launching thousands of satellites out there. So they've already mentioned they're looking to sell, but in the meantime, they are cutting a lot of, trying to contain the losses. Yeah, so that is the other positive. So we maintain our earnings, our target price, nothing changed. They just wanted to remind everyone, you look at under the outlook, the bullet point, that the Middle East conflict hasn't impacted any project delay or supply chain. But the most exciting part of the business now is the international defense. So basically selling the 40 mm, 150 mm ammunition, no, that you shoot that you've mortars and sort of the ammunition. And also they mentioned that there's 11 billion worth of opportunities that they will pursue in the next 2 years. In the past, they mentioned 5 years, but right now they say this 11 billion opportunities in front of them for the next 2 years. So, and international defense has doubled. They didn't give a number, but they say it's doubled from last year's number. So, which the first 3 months, 4 months already doubled. So just to get back again, the last bullet point. So order book has jumped 16%. So this gives a lot of good visibility for the in terms of growth. And some of the defense, international defense is a land platform they got from Qatar, maintenance of vehicles. You can think like the Bronco, the T-Rex, those type of armored vehicles, maintenance. And they also secured gunboats from the Kuwait Naval Force. So Middle East is going to be a very key market for obvious reasons. I guess one interesting development, what's the most popular product right now will be drone defense, because I think, again, for obvious reasons. So that's something that ST Engineering also can provide. Drone defense, either drone versus drone, you shoot down the drones, good luck with that, or you try to jam the signal of the drone. So these are some of the type of products that are, I guess, popular now. Next slide. Next is Singtel's results. So Singtel's second half results, I think the share price probably took a hit because there is a Middle East conflict. Probably the jump in energy is impacting them, causing a bit of bumps, slowness in the earnings. Next slide. So in terms of the second half results, if you go to the results part, it's within our expectations generally. I think they hit like almost on the dot, 98% of our revenue EBITDA. So they actually guided lower the earnings growth. So 2026, their earnings, which is EBIT, which is operating earnings, grew about 10%. Now they're guiding low to mid single digit. I think they did mention that they are taking a very conservative view, because what's happening is that with the rise in inflation, that would impact the countries that they're in. So most of the countries that they operate are energy importers. So you can think of Thailand, Indonesia, India. So if inflation rise, then telco spending might come down. And then, of course, energy costs, although they've hedged it in Singapore, you cannot avoid it. You cannot hedge forever. So they are just worrying that the energy costs will start to creep in. So that's why they are a bit conservative, guiding lower. The market didn't take it well. The market just sold them down. So let's go back to the results. So the one thing about Singtel, most of the growth right now is of course still coming from the associates. So associates, we're talking about India and Thailand. So you look on the left here, the red bar, the red box. If you look at the second box, regional associates, sorry, is a very small, but we don't cram everything in. But the earnings actually grew 19% because if you're excluding InTouch, but they kind of sold it or merged it with Gulf Energy. But if you take that out, the underlying growth is about 19. The growth is coming from Advanced Info, which is, I think, has a SDR here as well, but their earnings grew about 40%. And Bharti Telecom, the earnings grew about 30%. So Bharti and India rupiah was hit by 10% decline. So the growth would have been even stronger for Bharti, but just that because of the currency. So the negative is Singapore mobile competition. I think nothing new here. So the last few quarters. So if you look at the table here again, sorry, on the left here, under EBITDA Singapore, you notice that the earnings drop about 11%. Because as you know, in telco business, once you cut prices, you cut $1, almost $1 all goes down to the bottom line. So because there's very little variable cost in this business. So that's why the intense mobile competition is a negative. No change in our accumulate recommendation, but we took down our target price. Mainly because most of the analysts, how we value Singtel is we do mark-to-market valuation. So we mark-to-market the valuation of Bharti to our target price. And because even the Indian rupee itself also dropped 10%. So obviously there's some impact to the way we do the valuations because the share price held, but the currency came down. So just to as a nutshell, so the Middle East conflict has caused a headwind, albeit short term, hopefully for Singtel, that the energy costs weaken the currency, slow economic growth, and then tighten consumer spending, which is all these emerging markets. But the exciting part for Singtel, the next leg of growth for them is that their increased exposure to all this digital infrastructure and AI. So how Singtel is going to ride on this AI wave is that they of course are acquiring a 25% stake in ST Telemedia's data center, which I think got 100 old data centers. They are now going to this new business where in the call a lot of questions were on this because it's totally new. We should call it GPU as a service. So they will get the GPU from Nvidia and then sign contracts. Normally sovereign, so probably a lot to do with the government. They will get the best Nvidia chips, and then they will do GPU as a service. That means then they will sell the GPU on an hourly basis and so forth, or on a per megawatt, and they will secure like a 2-3 year contract. So this is a good business for them because they see there's a lot of growth. They have got already 600 million orders. The next one is fiber connectivity. These are the hyperscalers ones, fiber. And the next area where they're exposed to AI is NCS. NCS is like IT service company. So they're generating a lot of customers who want to do AI and how to use AI for the business. So that's why Singtel is getting exposure to this whole whole AI wave. So that is the exciting part for them. And they are also doing share buyback. They're going to do like a 1 billion of share buyback this year, on another 800 million or 1 billion, because they got 1.8 billion of share buyback to do the next 2 years, takes 2 financial years. They've only done, they're supposed to do 2 billion, they've done like 223 million. Next slide. Okay, there are a lot of notes here. I won't run through all this. So this is all in my report. So what I do is just give a commentary on all the various divisions because there's so many. So I won't run through everything unless you have questions. So they are still going to pay special dividends. They call it VRD. I mean, yeah, I can have a lot of funny jokes on that, but anyway, it's called VRD. Yeah, 3 to 6 cents on top of the ordinary dividend. Yeah. Okay, next slide. So my last company I will discuss will be Telechoice. So they're delivering growth, and then we are hoping to get this bumper harvest, a big data center contract, which I mean by bumper harvest. Next slide. So let me run through because Telechoice, most of us may not actually know what they do. So Telechoice has 3 parts. So this one you see here is called PCS. So 2 years ago, they secured a contract with U Mobile, which is the new mobile operator in Malaysia that got 5G license. And then they manage the supply chain for them. So that's doing very well, and it's the most profitable. The rest are a bit smaller. ICT is IT system services, and then NES is like network. You install 5G equipment and so forth. So the results was within expectations. But it was a very strong number. They got like 80% growth in PBT. So the positive is the PCS, which is the main contributor to earnings. You can see from here, is up about 90% to 2 million in the first quarter. And then the negative is small, so that's saying that it's not very profitable. But in terms of the outlook, we maintain our earnings, we maintain our buy, but we raise our target price. We're pushing it up to 18 times. It used to be 15, but the whole market is getting elevated, like CSE and so forth. Like I think like that's like 30 times PE. So that's why we're pushing out our target price. So we expect the second last bullet point. So we expect stable growth with their key customer. And then because the U Mobile is ramping up their subscribers, so when you get new subscriber, of course you need phones, and then when you move into the postpaid plans, you will need to subsidize the phones and so forth. And because phones are expensive in Malaysia, so most of them will need subsidy and they will need phones from U Mobile. Network engineering is entering a new growth because they are doing data center work and also doing the installation of 5G, but the rupiah will be the thing that might be the big headwind for them. But the key share price catalyst will be, they've already mentioned that they are pursuing a very large data center contract. And we think even if they get it, they could actually not just get one, because once you secure that and then people see that you have the ability, you've been qualified, they could actually get a few more such data center contracts. And also they mentioned that they'll get this within 6 months, they will get to, hopefully there will be some, whether they will secure it within 6 months. And then Telechoice has also been undertaking share buyback as high as 26 cents and above. Because the volume is thin. Sometimes the volume I notice is almost all of that. They are like sometimes 90% of all the volumes. Yeah. Okay. Let's move on to the next slide. So I'll just run through our usual weekly update. So in terms of the macro, the macro numbers actually show Singapore economy is actually doing really well, even though there's a Middle East conflict. So let me just go through. So for exports, we are up about 24%. I think you can say this is like the fastest growth in almost like 20 years or so forth. What's helping our export sector do so well is electronics up 67, but more important is semiconductor. So semiconductor is up this mind-boggling like 83% growth. So slower than last month's 100%, but year to date it's still up about 80%. So semiconductor is really ramping up in terms of the exports. Ready-mix concrete is also doing really well. So ready-mix concrete is the wet cement. The two main companies listed ones is Pan United and also Hong Leong Asia. But I think this is like record numbers that they're enjoying. So first quarter, the volumes are up 30%. So you can imagine the earnings growth you should expect to be even higher than this. Loans, there's nothing much. Loans in the US is also doing well. Okay, yeah, next slide. So as usual, we will provide our usual tactical views. So of course, the hot news now is SpaceX, or you call it the space exploration, whatever technology. The code is SPCX. So I did read the prospectus. I didn't read every single page because it's too much, but just to share with you the key highlights, we will probably come out with a more detailed note later on, because right now there isn't much numbers on how much they're going to raise. But the sum raised is expected to be 75-80 billion, market cap 1.7 trillion. If you look at the financials, they are losing money. They're losing about 5 billion. The losses is worsening. So in the first quarter, they lost about 4 billion. So over the next, if you're analyzing it, probably they could lose maybe 16 billion. But most of the losses, if you look at it for first quarter, most of it actually comes from their AI business. So more than half of it. Starlink is actually profitable. So there are three parts to SpaceX. There's the AI, the XAI, which they're going to become like teraflop sell the capacity, or no, they're like a normal LLM or like a normal ChatGPT or cloud and so forth. The second business that they have is Starlink. So Starlink is profitable. So Starlink is really like providing communications, satellite communications to customers. So I think they got like 10 million customers, and they doubled over the year. So that is doing well, profitable. The third and final business they have is space. That means they shoot rockets into space. So you want to provide any satellite and so forth. So that is losing money. Okay, but anyway, let me go through what is the dream. So total addressable market, or you call it the dream. So their addressable market is 28 trillion. Most of it is actually AI. But some of the things that are going to drive them to hit this addressable market is so they have Starship. They're going to launch the new Starship that will load. Because when you fire the rocket, most of it is fuel. But So from the Phillip that they're using right now, they are going to launch the V3, which the load will jump from more than 5 times, from 80 metric tons to 100 metric tons. Let's call it a commercial load. I'm going to make it easy for everyone. They're also going to improve on Grok. So that is the one that's going to take everybody's job, I guess. They're going to make it to AGI and then limitless duplicates of human-like intelligence. I'm just copying it from the prospectus. So of course, this is the one that will, the biggest TAM, take everyone's job. Not a fun thing, but anyway, this is what they put in the prospectus. The number 3 is a terafab. So terafab is to become basically like the next TSMC and then drive like 1 terabytes. And they're going to do orbital AI, basically data center in the sky. So they will use solar energy, which they say is limitless, obviously, and then use laser to communicate with each other in the sky. And then the ultimate one, of course, they're going to build a base in the moon and Mars. I don't want, we're just not going to talk about it, but let me just move on to the next 2 points. So they are cash, so they are losing their free cash flow is a negative 9 billion, mainly because of the capex. So most of the capex is going to go into Grok and AI. So what is the implications? I'm not talking about SpaceX, but what's the implications for the other tech sector? So it is creating competition. So they claim they can build a data center in I've forgotten the number of months. So sorry, I slipped my mind. But it's going to compete against, of course, the hyperscalers like Amazon, Microsoft, and Google, because they already got one big customer, which is Anthropic, 15 billion revenue. So they're going to sell this data center with 15 billion per year revenue coming from Anthropic. So they're going to become a competitor for all the hyperscalers. The another competition is, like we mentioned, is they're going to spend 119 billion on the wafer fab, competing against TSMC, working with Intel and fight against Samsung and TSMC. Of course, they are also an LLM. They're going to fight against Gemini, ChatGPT. So they are going to be a big competitor to all these tech companies. But we think the big winner, so how to make money, right? Of course, the big winner, the big beneficiary, we think is going to be semiconductor equipment makers. Like you're talking about your ASML, Applied Material, Lam Research. Because these are the companies that SpaceX is buying and not competing. So why this is important for us is because the main suppliers, as we know, will be companies like Frencken, UMS, maybe Micromechanics. So these are the big winners. I think once SpaceX come out, they raise the money and they'll be spending on it. So they'll become the big customer rather than competitor. In terms of some of the key events, we will have Valuetron, Costco. These are some of the results coming out, and then the PCE. We will also some corporate insights webinar open to everyone. Some of the new ones will be Yoma, AvePoint, IX Biopharma. So you can just register. Of course, the registration may not be open yet, but you should expect the June ones to be open. Next slide. This is my last slide, just to show you the chart on the left is just ready-mix concrete. You can call this the Pan-Yu Hong Leong Asia chart, I guess. But you can see the volumes are really rising. You can ignore the 2022, which is pandemic, but the volumes are really growing very fast because a lot of construction activity on the ground, obviously. And then this is the chart on the exports in Singapore. You can look at the green bar is like shooting to the moon. This is like the SpaceX. I'm just kidding. This is like a rocket ship for semiconductor exports in Singapore, just skyrocketing. The red bar is electronics, which is essentially largely because of semiconductor, and the blue one is just the general exports out of Singapore. But I mean, the key point, as the title suggests, are just very buoyant conditions for Singapore. Okay, I think that should be the last one. I can move on to Q&A. Thanks everyone for listening.
Yeah, thanks, Paul. I'll take on some questions. See a lot of semicon questions, but maybe I just take some and then hand over to the rest of my colleagues. So what do I think of Marvell and Dell results? We don't cover Marvell and Dell, but for Marvell, they're in the custom chip space. So can think of it a bit like Broadcom, a smaller Broadcom. In terms of custom chips, I think there's increasing demand now because hyperscalers are wanting to design their own chips, which are more efficient in terms of performance per watt. Right now, Marvell is trading at a premium, about 50 times forward PE. So I think it's priced in already. But I think their results will do well. Yeah. As for Dell, they designed the data center server racks. Yeah, so their traditional PC segment should face some softness because it is now the down cycle for the PC market. But I think there's a lot of hype in Dell regarding the data center segment. Yeah, so I think that segment should do well. Yeah. Why do I think Nvidia can play successfully in the standalone CPU space? Yeah, so traditionally Nvidia has been designing its own CPU using the ARM-based architecture. So basically, for example, you can think of CPU. There's two parts to it. One is the blueprint, and then one is the actual building of the CPU itself. So you can think of it like building a house. You need a blueprint for the house first before you build it. So the suppliers for the blueprint is ARM and Intel's x86. So ARM is the biggest, about 90%. And for this blueprint itself, both Nvidia and AMD use ARM's blueprint to design their CPUs. So Nvidia and AMD's CPU, you can think of it as they are built on the same blueprint itself. And for Nvidia's most recent Grace Blackwell GPU rack itself, it consists of Grace CPU and Blackwell GPU. So Nvidia's CPU is already operational already. And for the next generation Vera Rubin GPU rack for Nvidia itself, it's also Vera CPU and Rubin GPU. Yeah, so their CPU is already industry standards, and I think it can play successfully in the CPU space. Yeah. What's the likely CPU market share? Yeah, so just a follow-up for Nvidia, AMD, and Intel. Okay, right now the CPU market share is about 60+% to Intel and about 30+% to AMD. If Nvidia joins in the picture, I think that AMD will be able to maintain this 30+ market share. If Nvidia takes any of the market share, maybe like 10-20% of it, it will mainly come from Intel, I believe. But even though Intel may face some pressure, the entire CPU space is expected to grow very rapidly, at least like 2 to 3 times in terms of because of this new wave of agentic AI, the amount of CPU demanded is expected to spike up 2 to 3 times. So even though Intel maybe they lose like 10-20% market share to Nvidia, the entire pie is going to grow like 2 to 3 times. So all three CPU players are expected to benefit. Yeah. What's driving the volume of radar antenna for Frencken? What are these antennas for? Yeah, so Frencken collaborate with Gapwave, which is their production partner for radar antennas. And these radar antennas are used mainly in automotive. For example, you can think of it as when cars, in their safety features, they have antennas to sense whether nearby there are any cars or obstacles nearby. So that's one application. Another application is, for example, the use of autonomous vehicles. As it ramps, Frencken and Gapwave will be able to benefit from this increase in demand for autonomous vehicles. Yeah. Can I elaborate more on the analytical, life science, and medical segment? Yeah, so for analytical life science segment for Frencken, they supply microscopes for Thermo Fisher. Yeah, so Thermo Fisher is their main customer in the analytical life science segment. Recently there's a decline in revenue growth because US research cut their funding. So Thermo Fisher is also hit. Yeah, so that's why I mean that's the analytical life science segment. For the medical segment, Frencken supplies digital pathology equipment for Philips. So you can think of it like, so digital pathology means basically scanning for the patients, using digital scanning to monitor a patient's health. So it can be, for example, patient tables or like X-ray monitors. Yeah, so these are the kind of products that Frencken supplies to Philips. Pertaining to UMS, why is the stock pullback so fast from so far from its recent high of $3.15, and will its fundamentals stay strong in the high $2.60 plus to low $2.70 plus price range? Okay, so I think I answered the first part first. Why has the stock pulled back? I think it's broadly in line with the entire semiconductor industry. So the entire semiconductor industry pulled back about 10-20% starting from the middle of this month. And I think it's mainly because of profit taking. It had a strong run up the month before. But overall prospect for semiconductor is still strong. I think like what Paul mentioned with the SpaceX IPO, I do think that it will create a form of catalyst for the entire semiconductor industry. And with the increased capex guidance from hyperscalers, this will drive the growth going forward. Whether or not for UMS itself, fundamentals will stay strong in the price range you stated. That one I can't really comment on the price range because I'm not sure over the next few months how will the price react. But currently, if you look at UMS trading at about $2.70, its valuations is about 40 times, 41 times PE, forward PE. So that's a bit on the premium side. Average is about 37 times PE. Yeah, so currently UMS is trading a bit on the premium side. Yeah, but overall, fundamentals should still be strong because they have very strong demand from their customers, customer L, which is the equipment company, and they are shipping more of their inventory to Malaysia. Yeah, for this customer. Yeah. Is IBM the next Intel? I think it depends on what you're looking at. Because IBM, the huge chunk of its revenue comes from software, if I'm not wrong. And they also do consulting as well as data center hardware. Yeah, so in terms of diversification, they have a lot of segments. But mainly, I think the share price is hit because of the software. The software side is impacted as the entire software sentiments are gloomy this year. Whether or not it can turn around to be the next Intel, that one. Okay, so I mean I comment more on Intel. The Intel the turnaround story is mainly because of the new CEO coming online and because US government took a small stake in Intel, so it's able to broker quite a lot of relations for Intel. For example, Intel recently won the deal with Apple to manufacture its chips. So I think for that to happen to IBM, maybe similar things have to happen. For example, like the US government have a stake in them, or there's more emphasis on the hardware side. Yeah. Sorry, can't really give a good answer because I don't cover IBM. Yeah. For AMD and Micron, lately share price weakened, any tailwind ahead? Yeah, so the share price weakening is mainly because of the semiconductor. Like as mentioned earlier, I do think it's because of profit taking of the entire sector. As for tailwind for AMD going forward, I do think that its server CPU can continue to gain market share from Intel, and because the entire CPU TAM is expected to increase 2 to 3x, so that will benefit AMD. For Micron, the tailwind forward is that current memory DRAM is still facing a severe shortage. And based on my estimations, it will only the supply demand crunch will only ease in second half of next year. So Micron will be able to benefit from increased average selling price as well as volume to sign more contracts with new customers. And I think it will be able to, because Micron is one of the prominent high bandwidth memory players, apart from the other two. Yeah. A possible share price catalyst for Micron could be SK Hynix listing is in Nasdaq second half of this year. It could bring up the valuations of the memory companies. Yeah. I think there's a lot more questions, but maybe I hand over to my other colleagues. Thanks.
Hey, thanks, Iqbal. Let me just take this quick question first. I think I got one on the banks. Yeah. So, this is basically asking, what's the outlook of the banks, and also because, both DBS and OCBS continue to break all-time highs, and also, what are the new drivers, if there's any new target price or recommendation. And the last one is also on any potential of stock splits. Yeah, so for stock splits wise, I think the question was very directly asked towards, if I'm not wrong, it was DBS and even UOB as well. Yeah, and then both of them said no, they don't think they're not going, there's any, not in the near term at least, for any stock splits for either or any of the Singapore banks. Yeah, but yeah, so that's for that question. That's the easy one. For the others, for the thoughts wise, yeah. So I think our thesis for the bank still remains the same. The main thing, driving the bank's growth, moving forward will be the non-interest income, right? So we are seeing all three banks, did have quite good non-interest and fee income growth, right? This is mainly, from the lower interest rates, and the wealth management fees are also growing. So we continue to see that, right? Interest rates are normalizing sort of, right? But then again, they're still remaining very low. So it sets a very good environment for the Singapore banks because fee income will continue to grow, and they're also pushing very hard, right? Apart from the organic growth that they're seeing, from the inflows that are coming into Singapore, but they're also pushing very hard to continue to grow their fee income by hiring more RMs, expanding their reach, also their digital capabilities. So they're doing a lot of things in order to continue growing their fee income. And we're actually seeing it also in the first quarter. I think the second quarter was sort of, again prove our thesis whether or not fee income growth will continue. And I believe that it will continue all the way until the end of the year. The other macro environment factor that is very positive for the banks is that we are looking at a higher for longer rates in the US, right? So rate cuts are essentially non-existent now in the US, right? Even then, it will be very few, and this will set a very good backdrop for the Singapore banks because they're able to move over, their excess deposits and cash into higher sort of like interest like of products, like the treasuries and securities. So that's how they're able to actually maintain their margins. And in terms of margins wise, it's also quite positive. We are seeing that net interest margins are have sort of stabilized quarter on quarter. So I think there is also some upside to the net interest margins that they're all guiding for. Yeah. So in terms of which is our favorite bank, it will still continue to be DBS because we still believe, that they are showing, they're showing all the signs, like good dividends, good wealth management growth, and also very stable net interest margins. Whereas the other two banks, they have one or two of each, right? So for OCBC, they have very good wealth management fee growth, but if you look at the margins, it's actually continuing to crash the worst amongst the three banks, and also their dividends is, basically still 50% of dividend payout ratio. Whereas for UOB, right, their margins has stabilized very well quarter on quarter, but their fee income growth is quite disappointing. It's like mid to low single digits, whereas the others are not giving like double-digit count growth. And also their dividend payout ratio is also tagged at 50%. But for DBS, they have all three. They take all three boxes for us. Very high dividend payout ratio, over 70 to 80%, and it's going to continue all the way until the end of 2027. Their fee income growth is also very good at double-digit growth, and then their net interest margins is also stabilized quarter on quarter. Yeah, so that's why we continue to like DBS. Our target prices and recommendations have not changed. I'll just type it in the chat here. Yeah, so that's all for me. I'll hand it over to Darren. Thanks.
Yeah, thanks. And yeah, many questions. Let me try to answer some. Yeah, why does AIMS APAC REIT outperform Stoneweg? Both are in logistics. Yeah, you're right. Is AIMS in SG Aussie play for exposure to Australia? Yeah, so AIMS is about 70% Sing, 30% Australia. Yeah, so if you like to know more about AIMS, also just so happen, I think this Thursday or Wednesday we have a corporate insights with AIMS APAC REIT. So Russell will give a presentation. You can ask questions there. Yeah, yeah, but if you ask me, is AIMS And SG Aussie play well, Stonework is European plate. Yeah, you're also correct. And the last question is, what's your view on Stonework getting into data center? Yeah, so for Stonework getting into data center is basically I think there's a huge upside potential there, mainly because they are leveraging on their sponsors so-called expertise in the data center platform. So if you do not know, Stonework currently they have about $100 million that are invested in the sponsors data center development fund called Ionics. So that is really a development fund, and there is a lot of upside potential. I mean, early numbers indicate that the valuation on completion of these data centers could potentially be 3 times of what it is now. But then again, that is just forecast, so it's hard to say about that. Generally, there is a lot of upside from data center. The valuation in there, a lot of upside from the 100 million investment there. Yeah, so the 50 million investment that they did last year already saw 40% uplift in valuations, and they had another 50%, or rather 15 million invested through a convertible loan. Yeah, so that they can convert into equity at a steep discount at the end of 7 years. So that will also give them a lot of NAV upside potential. Yeah, so that I believe gives Stonework a lot of capital upside potential for that. Yeah. Yeah, and we did not know also their sponsor recently just invested into a Nvidia preferred partner. I think it was Polarized, if I'm not wrong, the name of it. Yeah, so that will also help with the operations of the Ionics platform. Yeah. Yeah. You asked the first part of the question, I missed it. So why did AIMS outperform Stonework? Both are in logistics. Yeah. So I think AIMS generally outperformed over the past few months because of the expectations of ECB rate hikes. So that might potentially impact Stonework a little bit from the floating portion, because they are right now their cost of all-in hedge ratio, I think 87%. So if the ECB does raises the rates, that might impact Stonework a bit. While on the other side, the AIMS still seeing SGD loans. I mean, despite their Aussie side raise rates, but bulk of their portfolio still in Sing dollar loans, so it still benefit from lower rates. Is news of Quek Ling Pek rejoining CDL board good news? Yeah, I think so. So, yeah, I don't want to comment too much, but he has a lot of experience. So, if you do not know, previously he was on the board of CDL until 2020. Then, following some disagreements with the Sincere Property investment, then he stepped down. Yeah, but now he's back. So, just in time for the strategic review. So, we think you can leverage on his expertise for this strategic review as well. Yeah, I think that's a positive. Do you expect CDL's divestment impact CDL HT positively? Okay, so we'll generally will not have any impact unless CDL divest some of their hotels or hospitality assets to CDL HT. So yeah, unless that happens, I don't see any impact to CDL HT. How much can CDL expect to receive back, especially for the China assets? Do they have to make provisions? How much? Yeah, so for China assets, we've seen impairment losses for over like 2-3 years already, non-stop. So the assets have already been valued really impaired already, and the valuations are fair value is already decreased or declined quite a bit. So from what I've spoken to some of the those who operate in China during this first quarter 2026 update or financial results. So some of them that operate in China, they believe that they are close to the bottom in portfolio valuations, or in China valuations or getting there soon. So I mean that's mainly because after like so many years, like 3-4 years of continuous decline in valuation. So definitely there will be a bottom there, but so the sensing I get is possibly bottom out already for China. So yeah, if they divest also because operation conditions still remain challenging, might not be at valuations, might still be at a discount valuation. So that is really hard to say how like whether they can um divest and how much they can actually divest from China. But yeah, they have plans to divest China and yeah, I can't really comment on that, like how much we plan to receive or what, but hopefully they can get it at valuations as the assets have already been marked down quite a bit. How about the performance and outlook on healthcare REITs, Parkway Life REIT? I mean, there are two healthcare REITs in Singapore, Parkway Life and First REIT. So for Parkway Life REIT, the operating performance will improve this year for sure. That's mainly from the completion of the project Renaissance. So they're looking at about 20% DPU jump from the completion of that and the new lease structure. So with that 20% jump, we are still looking at a yield of slightly below 5%. Yeah, so generally, especially since completion of this project Renaissance, if they can shift it to the profit or revenue sharing model from this current base model, then there will be more upside for Parkway Life REIT. Yeah, that's for Parkway Life. For First REIT, basically they are soon to be a non-healthcare REIT, if you ask me, because once they divest their Indonesian hospitals or Indonesian portfolio, which mainly consists of the hospitals, they are left with some nursing homes in Singapore and Japan, and I think likely they will use the proceeds from the Indonesian portfolio to invest in other sectors already. So going forward, they might not be a healthcare REIT anymore. Yeah, that's just my view, but they are still undergoing the strategic review, so hard to say what they'll start investing in. But right now, First REIT is still once they divest the Indonesia portfolio, they will be very cash rich. So we have to see how they redeploy their assets. Yeah, so we value First REIT based on price to book 1x because mainly it will be all cash after they divest the Indonesia portfolio. Why did Digital Core and Keppel DC share price react to their rental reversion? So Keppel DC REIT is really not new news that their rental reversions were that strong. I think it's really become a norm. So over the past few quarters, we've seen Keppel DC for their Singapore co-location assets, they've already had like over 40% rental reversion for multiple quarters. If I remember correctly, I think at least 4 quarters of 30, 40, 50% reversion. So I don't think that is it comes as a surprise anymore. But for Digital Core, it was a surprise. But for Digital Core REIT, if you ask me, I think mainly because there's still some execution risk at the Linden Hall redevelopment. So I think that is also partially why the share price didn't really rally, as there are still some uncertainties there, but generally it's still the tenant really locked in, so is resilient. But definitely still the completion of the redevelopment is to look out for. Given the transfer sector in REITs is better off retail or industrial, yeah, I gave a quick roundup earlier during my REITs monthly, but for REIT, I think retail tend to perform the better because first of all, we think there are a lot of, I mean the headwind from the so-called the RTS, we think that is really overblown. That's the thing that a lot of investors are worried about, the RTS impact on retail. But generally, from what I see, we are talking about the incremental leakage. As personally, I feel that a lot of let's say Singaporeans or people in Singapore who spend, who go to JB, who will go to JB to do grocery shopping or whatnot, they are already doing it. So with even without the RTS, they're already doing it. So we are talking about the additional people who will go in just because of the RTS. I don't think it will be that many, to be honest. Even though the current KTM capacity probably around 8,000, the RTS around 40,000. So when the RTS happens, the KTM 8,000 capacity will be removed. Yeah, so there is some capacity, but it's also two flows. Like Malaysian, more Malaysians will come to Singapore. So the impact, I think, will be minimal, in my personal view. So we still think retail will be strong. Yeah, for possibly the northern side, the malls that might be impacted, we think the landlords will start repositioning the malls to cater to so-called the loss in sales at those malls to JB because of the RTS. So we'll monitor that as well. But we generally don't think the impact will be much. But for industrial, reversions generally across the board, we see that moderate because over the past few years, since 2020, since COVID, there was a spike in logistics demand like e-commerce and such. So we saw the rental reversions like double digit for many quarters. I believe not even quarters, I believe 3 years of double digit rental reversion. So we think that has slowed. So going forward, we think in the industrial rental reversions will also likely slow, but coupled with the fact that rising oil price and might impact the tenant profitability from transportation and their margins. So the second order or longer term impact on the industrial is yet to really flow through yet. But generally, industrial demand still strong. Yeah, but if you ask me which sector I prefer, I still prefer retail. Yeah, there's one question from CK. Yeah, thanks. You mentioned good rental reversions from KDC and Digital Core. How about NTTDC REIT? Yeah, so NTTDC REIT, they are experiencing good things too. Their results were strong and they also renewed the Singapore lease at, if I remember off the top of my head, I think 23% positive rent reversion. So this was a really positive upside surprise, and it's a 3-year lease also from the previous 1-year renewal. So that's a huge plus. But portfolio wise, I believe if I remember correctly, that rent reversion also was almost 10%. So that's also good news. And acquisitions wise, they are also looking to acquire some properties. So yeah, I believe NTTD Suite still, yeah, they're experiencing some good things too. Also, secular demand from the data center demand. Yeah. Yeah. Another question you have is UIB REIT's leverage ratio touched 40% with the latest announcement of its co-investment with the sponsor subsidiary. Yeah, the Selita. Is this bad for a new REIT as in UIB? Yeah, so if you're just asking about the leverage ratio being at 40%, I think that is still healthy levels. Especially since right now investors still, or institutional investors as well, look at 40% as a good gauge, even despite the fact that previously leverage expectations, like the MAS leverage limits was 45, then they raised it to 50%. So despite that raise to 50%, the investors' expectations is still to keep the leverage around 40%. So I think that is still healthy and yeah, acceptable level for even a new REIT like UIB REIT. The other question is, if Fed raise interest rate, is it normal or necessary for SARA rates to follow? Yeah, so if Fed raises the interest rate, I think there will be definite pressure on the SORA to increase as well, but it's not a like for like increase. So there are situations in the past also where when Fed raise rates, the SORA also didn't increase. So generally there is upward pressure when the Fed raises rates on the SORA. Yeah, but there are situations where it diverges, like possibly excess liquidity in Singapore or strong SGD appreciation expectations. All these might help to kind of limit the rise in the SORA. Class, at what price to book level will you consider class as a buy? Yeah, so at this level, about 0.8 times, we think is attractive. A bit, like during my REIT presentation, I came out I said the hospitality sector they are facing some headwinds, but for class, their portfolio is more resilient than the normal hospitality player, mainly because they have over 65% of their assets are on stable income sources, meaning master leases or management contracts with minimum guaranteed income. So their source of income is really resilient compared to if you are on a pure management contract where your income comes from pure RevPAR. So they are more resilient than some of their peers. So we do have a target price of $1.08. I think currently it's trading at 0.8 times price to NAV and about a share price of 90 cents if I recall correctly. Yeah, so we think at this price that is still a buy. Yeah, I think it's quite a few. I'll hand over to my colleagues. Yeah, thanks.
I can take a few questions. I think first question is CNMC seems to be struggling. Is the TP of $2 plus still valid? I think gold price has been increasing the past few days. It's trending around 4.5, but for CNMC in particular, I think there is some overhang related to their business itself. So for CNMC, they're currently pushing back on the increase in royalty rates. So for gold, their royalty rates is proposed to be increased from 10 to 15%. For silver, from 10 to 12% by the Kelantan state, and they're currently pushing back on that, and that is uncertain. Overall, we are bullish on gold. And the current price is around where our gold price assumption is also. So because our target price is for a year forward, we think the $2 plus is still valid at the moment. But we are on the lookout for how the outcome of the proposed increase in royalty rates will pan out. How is SET's result expected to fare today after market close? I think this I'm not too sure. So we have to wait and see, because unlike SIA, for SETs, their operations are more global in nature after they acquired WFS. For SIA, majority of their revenue is from East Asia. For SETs, Europe, Middle East, Africa, and Singapore makes up a considerable portion of revenue. They also have strong operations in America. And American airlines, they don't have the same hedge profile, fuel hedge profile like Singapore Airlines does. So there was a lot of frequency reduction and cost cutting that they engage in. But overall, we think SETs would still benefit from rerouted capacity. So SET's business function is your food services as well as your gateway services, and we think both will be supported by SIA. Um, the unstable political situation in UK is making bond yield rising. Do you see this as a risk to elite UK REIT? I think, yeah, the bond yield is around. It actually reduced the past week. I think it's about 4.9% plus now. Previously it's about 5%. So we also attended a market sharing by Colliers, and what they guided us was that they are expecting yields to fall, and current interest rate is about 3 plus percent, and for FY26 and 27 it's expected to fall to 3.5 to 3.75%. And we think for Elite itself, majority of their debt is fixed and on a fixed rate, And even if there is an increase in interest rates, it wouldn't affect Elite in the near term because yeah, they do not have any refinancing needs in the near term. Then for SIA fuel hedging, how much and how long is the fuel hedging to remain beneficial to SIA? So I can share the fuel hedging profile for SIA. So this is their latest fuel hedging position. So majority is hedged on jet fuel, a small portion on crude oil. So hedging on jet fuel is more expensive. Crude oil, it's cheaper, but you're exposed to your refinery margin. So the question was how long and how much to remain beneficial. So typically what they do is they hedge on a rolling basis. So you can see that for the upcoming year, they've hedged their fuel needs. And then they will do this on a rolling basis where, say, going 2 quarters forward, they would update their hedging, and then this is going to increase your FY 27, 28 hedging will increase. And for it to be beneficial, you have to look at the price at which they hedge. So their current hedge is about 68 to 65 to $68 for FY 26, 27. Current Brent price is I think about $90+. So as long as your spot Brent price, which is about $90+, is higher than your hedge price, it's beneficial for SIA. And that's a hedging gain for SIA. I think that's all. So I'll pass on to the others.
I'll just do a very quick one because I think we want to pass it over to Zain because it's going to hit 1 p.m. soon. So I think some of the key questions was Valuetronics write down of its AI investments. What is your update views? Okay, so Valuetronics will release their results on Thursday morning and then we will do a briefing with them. But essentially, what Valuetronics was trying to do with this Trio AI was to do like what Singtel did, not this GPU as a service. So GPU as a service works if you can get access to the best the best GPUs or the most advanced GPUs that you can cut queue or basically like what Singtel can do. They can get the latest Vera Rubin, the GB300 or the 200, and then you can, of course, you got to get a very strong customer because your these customers have to pay the best rates. So you're basically renting the GPUs from Singtel or from Valuetronics. So and the risk is technology obsolescence. So for Singtel, what they do is they did try this model. They've been doing this for the trial for 2 years. So even Singtel was very worried about this service renting out of GPUs. Of course, Valuetronics braver. They just did it within 2 months or something. So for Singtel, they actually took 2 years to study this, and then right now they're ready to ramp it up from 1 megawatt, 11 megawatt. So they're gonna ramp it up 10 times. And so what I think what happened to Valuetronics is probably the GPU got replaced, and the spot pricing for GPU as a service came down. I think that is probably caused them to write off their GPUs. Because the only asset there is GPUs. That means there's nothing else. So they probably bought a lot of GPUs and then they got stuck with it because probably there's a new generation and the pricing for this rental, because even Alibaba and so forth also provide such a service. But for Singtel, Singtel is sovereign AI, which essentially means that they are renting it out to the governments, and and they are depreciating it over 2 to 3 years, the life of the contract. So at least you avoid the obsolescence, unless you think immediately after the third year, this thing just goes disappear, which shouldn't, because they're also using liquid cooling to kind of extend the life of these products. Yeah, I hope that helps. But we'll give you more details. The other major question was Geo Energy share is on a downtrend. Why there's news there's a potential investor coming in with billion of dollars and near completion? Okay, so Geo Energy share price got hit. The results wasn't good because the production didn't ramp. So the production didn't ramp because most of the production they are allocating for the new road, their new mine. So they got hit by that. Then of course this news that hits the palm oil companies, that hit the coal companies was because there was news that the Indonesian government wants to be the middleman. So you are to be the middleman of all any anybody exporting coal or palm oil has to go through the Indonesian government, which is obviously not feasible. Like, you can't do that. I mean, and then obviously they're going to take a cut of it. But the authorities announced that they're not going to do that middleman part, but more like a processing of all the transactions. So you want to export, you just have to lodge with them to notify them, because what they're trying to do is a lot might undersell their coal or undersell their palm oil price to get cheaper taxes. So it's mainly to avoid this tax leakage. The other thing the Indonesian government is doing is to make sure that you keep your foreign, when you sell coal or palm oil, you have to keep it. I don't know the exact number, used to be 50%, now they push it to 100% for that few months. Most companies already do it. So they do take their US dollar receipts and then park it with a local bank, maybe 50% or 30% of the receipts. Apologize, I forgot the exact quantum. So there is I can understand the weakness, there's the geopolitics, but again, for Geo, number one, they're going to seal the deal hopefully soon, that will put the value, but again, to that value the mine at 1.5 billion, and also coal prices are running, so coal prices from probably 47, 48 now is about $64, so that will support the earnings. So yeah. Okay, I'm sorry, we still got lots of questions. There were about 70. We can't answer all, but I will move it on to Zane to do the technicals first. Yeah. Thanks. Yeah, apologies. There's still a lot of questions. Yeah.
Yeah, thanks, Paul. I'll move on to the technical section. I'll just share my screen for that. So first questions is on Singtel. So in terms of I think current share price movement, we see some pullback from the recent area at around 495 over there, and currently today's about 460 about there. So I think past 2 days has been selling with high volume. So I think for now we'll still need to probably wait for the share price to kind of do a bit of a sideways first. Yeah. So in terms of current support, I think one support right now is still the 455 level, which is the swing low. When the share price kind of started to rebound, this was in start of May. Yeah. So 455, that's also a 200 SMA level as well. So and then afterwards, the next one will be around 447, 448. So I think for now, we'll probably still see some kind of sideways, I think, at 455 now. Yeah, and then resistance most likely will be around 467 to about 473. The next one for Keppel DC REIT. So for Keppel DC REIT, I think share price is most likely range bound for now. So the resistance is still likely to be at $2.32, which was a breakdown of this horizontal support level, and that's where the 20 SME is currently right now. And also we're just seeing price range bound with support around 226 about there. So I think that will still continue for the time being. Next one is 0778 Hong Kong, which is a Fortune REIT. So for this REIT, I think general trend is an uptrend, and but in the short to medium term, since September last year, it's turned more range bound. Recently price has pulled back from the start of the month at these key resistance at around 505. And also for some further weakness is when fell below this 490 level. So I think for now it's most likely still a bit of a weakness for now, and I think we could still see some some pullback towards the next key support around 480 about there. Then I think we'll do some sideways movement for this fortune. Okay, next one on Keppel. So for Keppel, I think the share price rebounded after the hitting the 200 SMA level, this purple line last week, and then also on Friday also broke above this 1078 level as well. So in terms of the next key, I think for now we most likely still see the price kind of inch out a little to test this key resistance over here around 1110 to 1120 area. That's where this we have this downwards resistance line also as well, which has been acting since end of February this year. So that will be the key resistance area for Keppel, and then support is likely to be this 1080 around here. So afterwards, I think we'll do a bit of a sideways consolidation after this rebound from the lows. The next question is on Joe Energy. Now, so for Joe Energy, there has been a very sharp sell down towards this support at around 45 cents, and this is also where, in terms of the daily time frame, this is also where around the 200 SMA is. So previously, I think the previous pullback wave, which was around here in January to March this year, price also managed to maintain the 200 SMA level, and traded sideways over here. In terms of the weekly, I think I also saw the price also retested the 50 SMA weekly, which is this green line over here. Previously also acted as support. So just nice it was around both at the 45 cents level as well. So in terms of the share price movement now, I think a bit of a rebound, but today is still facing some resistance at this upon the first retest of the 5 SMA around 50 cents. So probably see some pullback, but I think this support over here at 45 cents will hold. So I think price will hold support this 45 cents to about 46.5 cents area, and then do a bit of a sideways with resistance about 50 cents for now. Okay, then next one, moving on to some of the banks and also REITs. First one, the three banks. First of all, DBS. I think overall the banks have been still trending well quite recently. So for DBS, since the breakout of this $58.30 level, price movement has been steady along the 5 SMA level. So that's a very strong good momentum we are seeing right now. Also, last week was also kind of price did a bit of a consolidation here at some resistance at $62, but that has also today also managed to break out above that. So I think overall it's very good. I think we are still likely to see the price, I think, trend higher, continuing the uptrend to perhaps retest the upper Bollinger Band again, which is currently is about 63.30. Yeah, so I think that's still a very strong trend we're seeing right now. For OCBC, I think the price action is also quite similar since the breakout of this 22.50. Afterwards, price also broke out this $23 and also further which is this 23.40 level as well. So that's still new highs as well. I think we're still likely to see the higher highs afterwards. Next key resistance I feel could be around 23.90 to about $24, the next level. And then for UOB, also it's slightly lagging, but also kind of similar price action since the breakout of the $37 also. Price managed to hold this 37.50 breakout as a support, and I think we're still likely to see price trend higher as well towards the next key resistance will be around 38.40 to about 38.70 for UOB. And then moving on to the REITs questions. First one, Capital DC covered. Next one on CICT. For CICT, I think generally it's a very large range bound taking place in September last year. And most recently, price sees the breakdown of this 233 level. We retested this key support over here around 223, then did a bit of rebound last week. So I think for now, I think most likely we'll see a bit of a sideways movement take place over here with support around 228 and resistance at 232, 233 level. Okay, next one for Fraser Center Point Trans FCT, I think also kind of range bound. Last week we tested the resistance area around 230 and seeing a bit of a slight pullback. So I think currently is at the one support level around 225. So I think price will do some sideways over here and resistance at 228 to 230. So and then next support level about 223 and then followed by 220 about. So generally still very range bound FCT. For CapitaLand Ascendas REIT, yeah, I think will also be kind of range bound for now. Price is holding support this 248 recently. Yeah, also with a bit of a breakout of this 249, 250 level. So I think next key resistance above that is 254 to about 257 area. So I think that's a resistance, and I think support will still hold around 248 to 250 right now. So I think it's also a kind of range bound consolidation near term. And then for Mapletree Industrial Trust, so similar, price still holding the key support 190 to 191, and the key resistance right now is at 197 about there. So that with the near term higher low support around 193, 194. So I think that's also quite range bound for now. Next one for Wilmar. Wilmar has been in this range consolidation for some time. So I think key support over here, I think still be holding, which is the confluence of the 350 horizontal support level as well as this 100 SMA level, which is this blue moving average. So I think price is still a range bound. Last week we tested this level a bit of a slight lower wick being formed. Some resistance, I think, still this 363 level, which was the breakdown last week. Then price needs to overcome this level for further rebound towards like 368 or 370. So I think we'll still be, for now, I think still some slight resistance at this 363 level. Yeah, but I think the support will still hold around 350. Next one on Swell Build. Yeah, for Swell Build, I think share price has been pulling back quite a bit recently on some high volume as well. So there was also some acceleration in terms of the selling since middle of May. So I think for now, last week, some signs of a slight bottom in the very short term where we see price holding support at this 74 cents level and also this higher volume day as well. Currently, afterwards, there's also some contraction in terms of the volume. So I think for now, most likely we'll do some sideways with resistance at 81 cents as well, which is also the 10 SMA level, this red line over here. And above that, the next key resistance probably 85 cents, 86 cents for Swell Build. In terms of RSI, also at the lowest is here about 21, so it's in the oversold area in terms of the RSI right now. So I think I'll probably expect some slight rebound and consolidation. Yeah. Next one for Hua Tiong. Hua Tiong Global overall uptrend has been the range consolidation since end of February. In terms of the recent price action, some slight weakness with the breakdown of these 85 cents. There has been price is still remaining under that since the middle of this month. But I think the key support is still the 79 cents, 80 cents, this horizontal level, which is close to the 100 SMA level as well. And in terms, I think also at the lower Bollinger Band level as well. So I think this will still hold as support. And yeah, probably some slight rebound for now, with resistance at 83.5 cents to 85 cents area, which is this 10 to 20 SMA level, as well as the recent breakdowns. The next question is on Nordic. For Nordic, yeah, Nordic some pullback from highs recently. So I think for now it's most likely in a bit of a sideways consolidation, where we have some support near the lower Bollinger Band. This is around 55 cents this level. There's also the previous horizontal resistance in mid-April, and then resistance for now most likely at 58.5 cents. So I think price will do some sideways for now. Also, the volume has come down since during the up wave over here. Next question on IX Biopharma. So for IX Biopharma, in terms of the price action recently, some continued weakness since the breakdown of this like 39-40 cents range consolidation over here. And also another thing that happened last week was it fell below this 36 cents level as well. So and it's trading below some of the short-term moving averages. So currently it's finding this 5 SMA as a resistance. I think for now, resistance will be this 36 cents for now. In terms of the next support, I think that will be around the 33 cents level. That is likely to be the next support. And also another key support I think that will hold the price will be this green line, which is the 50 SMA level. So previously, I think last year during some of the pullbacks from the highs, I think price has managed to hold this key moving average. So that's also one level to look at, around 31.5 cents right now. So I think price will most likely do some slight further pullback towards this 31.5 cents to 33 cents area, then will do some rebound from there. Yeah, for IX. The next one for CSE Global, I think overall it's looks like some profit taking from the highs from 15 May, but then price pulled back towards the 20 SMA level, also the horizontal support at 148, and starting, I think also from Friday it managed to break out of this resistance at 161, which is also the 5 and 10 SMA levels. So I think with that, most likely we'll see the price recover for now. Maybe to try and retest this swing high again. So first level of resistance for now is this 178 to 180 area. And afterwards, if price can still close strong around that level, then we could see price inch up to retest the 190 resistance again for CSE. Okay, I'll take one more. Things about one for add value. Yeah, for add value tech, I think price looks like it's today with a gap up. Looks like trying to break out of this descending triangle consolidation over here. So I think some resistance for now, when we test this swing high at 0.157, yes, could be facing some resistance over there. But I think most likely we could see a higher low being formed afterwards when these short-term moving averages catch up. So I think in terms of the current support, I would think it's around 0.150 to 0.152 out there. Yeah. Then if price can hold this higher low, then I think there could be a chance of price trying to retest higher resistance levels like 0.162 to this 0.169 form at the end of April. Yeah, so that's for add value. I'll have back the time to maybe Paul if you have anything to add on. Thanks.
Yeah, thanks. Thanks everyone for joining us. I think Monday is a holiday, so we won't have a Monday session. Just one last part. I think there are a lot of questions on this StarHub M1 merger. So in general, if there's a StarHub and M1 merger, it's obviously will be positive for the market because you're just going to concentrate the market share to virtually a duopoly. And then Simba so small, I didn't know nobody will buy. It won't be a significant competitor to the market because the share will be much smaller. Yeah. But anyway, thanks everyone. I hope it was useful and apologize. There's still some questions we didn't answer because it's like 80. We try our best to type in, but do go to our poems community if you have any urgent questions. With that, thanks everyone. Have a good week ahead and have a good holiday break. Yeah, thank you, everybody. Bye bye.